Hi, I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. I've had a lot of people ask me about debt, why it's so bad, etc. So that's what we're going to talk about today. For one thing, you need to know that there are two types of debt. Self-liquidating debt, so in other words, you take on debt and maybe you expand your business. The business earns more money and it pays that debt off. So you can see the debt go up and then down. And then non-self-liquidating debt. And that's the kind of debt like the government builds a bomb and blows it up. It's never going to pay for itself. So those are the two types of debt. Now, typically when you take on debt, you have interest. So if this is the interest rate and this is the principal value of the bond, okay, when interest rates go down, the principal value of the bonds that are already issued go up. When interest rates go up, the principal value of the bond that's already been issued goes down. So that's why that's one reason why interest rates matter in this. And with the current interest rates at the lowest levels historically and the debt levels at the highest, perhaps you could see why that's a challenge. But now I'm going to walk you through this story. And I'm going to start with this Federal Reserve chart on interbank lending. Okay, so when the crisis hit, you can see this is banks loaning to each other, so they feel confident that they're going to get their money back. Well, all of a sudden, when the crisis hit, you can see that the levels of banks loaning to each other are back where they were when this whole piece just started. So it's quite clear from this, you do not give a loan if you do not think you're going to get paid. Banks do not trust each other. So who stepped into the foray? And this is very important, by the way, because it supports the market. So who stepped in? Well, the Federal Reserve stepped in rather a big way. Now, they now say that they're going to reduce this, but we'll see. That's another webinar for another day. You and I as taxpayers are responsible for that debt. That wasn't enough to create enough liquidity and credit. So here's QE1. This is the government buying treasury bonds. QE2, QE3. You do not see anywhere in here this pattern until you get here. This is a hyperinflationary pattern. And by the way, this is 1971 when we went on to a full fiat money debt system. Again, there'll be links so you go in and look at it. Now, that wasn't actually enough. So let me see, this is 2012, the Fed started buying the mortgage-backed securities and created even more debt. Wonderful. In addition, now, by the way, do you see anything going down? That would be a no. This is state and local debt without retirement and pension plans in it. Again, here's where we went on full debt. It just keeps going up. They don't intend to ever pay this debt off. I don't care what they say. Let's see. This is, the federal debt. And you know we hit the debt ceiling, that 20 trillion. We'll see they'll probably raise it. But again, not going down. This is personal consumption debt, not going down. These are credit card debts plus that have been turned into financial products. Again, not going down. Can you see this pattern here that I'm trying to show you? Student loans not going down. Auto loans not going down. Okay. Margin debt. Stock market at new high, so is margin debt. Okay, how is all of that possible? Why hasn't that exploded? I mean, if you put it into a personal level, if all you ever did was grow debts and never pay them off, well, at some point you're not going to be able to pay them, and we're going to talk about that in a second. But this is it. This is the only piece, this confidence in the dollar, the confidence that the markets will keep going up. This is the only thing that allows all of that debt to continue. Now, they say that they're creating all of this debt, and that creates all this new money, to stimulate the economy, so the GDP. Well, okay, it took over $10 in new debt to generate 64 cents in GDP. That is non-self-liquidating debt. At some point, it must be repaid. But the impact of this is quite clear. This is the purchasing power chart. There's only 4 cents left. So this is the impact of all of that compounding debt. And remember too, it's not just the debt. It's all of the interest on that debt. So even if we were to stop growing any more debt, which is definitely not what they're going to do, but if it is, this interest will continue to compound. Here's income, here's outlays, here's compounding interest, and there's the debt. I mean, it should be pretty self-explanatory. So debt is an obligation to repay. But once you have so much debt that those debt service payments make it more challenging to grow even more debt or stimulate your economy, then you have the most important chart, in my opinion, which is this monetary velocity chart. It is worse now than it was during the Depression in 33. That actually shows, I know we just looked at that chart on consumer confidence up somewhere near its all-time high, but this actually shows you that people are not spending money. So all of that debt growth, this is what's supposed to be generating the income to repay that debt, not happening. I mean, it's really simple, not happening. But this is what is the foundation of our money. So this little Federal Reserve note. Now, I'm not going to rip up this one because this is actually, I had to borrow it. But I'll tell you what you can do with that. That's what you can do with it. What kind of money? What's the only kind of money that has no debt attached? And definitely, you cannot tear that up. Gold and silver. Real money, physical, in your possession is the opposite of all of this debt. And there's even more that I could have shown you. It's the opposite of all of this debt. At some point, you either have to default on that debt or you have to pay it. Should be pretty clear. We're not paying it back. What's the other alternative? So, I hope that made debt a little bit more clear, why we're in a very dangerous position with interest rates and all of this debt. We haven't even talked about the obligations and the promises, just that. And that's it for today. Subscribe to us on YouTube, follow us on Twitter, like us on Facebook, and give us a call, 888-696-4653, and share this information with everybody. We need to know this. Have a great day. Bye-bye.